There are messages from some students that whether the session will be recorded or not. So obviously all of my sessions are recorded so that it's not only beneficial for the students during the fixed time, they can also watch it later. Welcome to today's session. Formally, I'm welcoming you all for this Advanced Financial Management AFM P4 session. Okay. Now, what is the purpose of this session? Obviously, there are few days left in the exam. Okay, there are a few days left in the exam, and there are many people who have completed their preparation. Okay, and there are people who are still doing their preparation, and their preparation is at end. But we feel basically that at the end of the session, when there are basically 10-15 days left in the exam, students need some very specific guidance on how to pass exam, or they need a quick refresher. So that's why this course is completed. Okay. Now, let me just give you a brief introduction about myself and how these webinar sessions have helped. Okay. Those who have studied from me before, obviously they know me, and those who haven't studied from me before, my name is Ahmed Shafi. Okay. And I am basically from Karachi, Pakistan. Okay. And I have been teaching this AFM exam, the Advanced Financial Management exam, since the last 10 years. Okay. And I hold the record of my students securing the most number of worldwide and nationwide positions. Most number of nationwide and worldwide positions in 2019 and 20. That's the last 2 years that have been secured by my students, alhamdulillah. Okay. Now, the reason why students secure positions, and we have a very good pass rate as well, as you can see that in optional exams, like you talk about the P61, ATX, the P7, AAA, forget about APM, I'm not talking about that, AFM. All these optional papers had pass rates ranging between 30% to 35%. And never there has been an instance, I remember, that the optional papers pass rates touch 42%. But we have worked really hard in the last 2 years, preparing students, preparing online classes, that last year saw a record pass rate of P4 in the last session. And December 2020 session saw the AFM pass rates around 42%, which is highest compared to any of the optional exams, 42%. That means when this paper has a pass rate of 42% in optional exams, there is something in which you can clear this exam. Okay, I would advise you to use the chat box as less as possible when I'm lecturing, obviously, because once I will give you the time, okay, let's ask question, you can answer as many questions or not, because at the moment, the questions like where we will watch the recording, or that's why I've made the WhatsApp group. Don't worry, all recordings and every detail will be shared with you. Okay, so the pass rates I was talking was 42%. Now, the reason of 42% pass rates is that basically the paper has some calculation stuff as well as theoretical stuff. And we have developed such techniques. The students enjoy such techniques and they ace the exam. Like how to, I don't know, there are many students I'm seeing who have not studied from me. They're freshly new students for me. And I bet that students face problems when doing currency risk question, when doing interest rate risk management question. They search the Kaplan kit, they search the ACCA past paper answer, and they are just bogging their head. How come this value came? How come that value came? So my tips and techniques are very easy one. I have developed almost for all topics, very easy formats that once you learn the formats and understand the formats, you will easily put the values and get the answer. And this will help you pass the exam, and that's what you need. So in this webinar, we will try to cover some past paper questions. And today, the topic I am covering is currency risk management with all of you. And we will be solving a past paper question as well through my techniques. And those who haven't studied from me before, they will see that using these techniques, things become very, very simple. Okay. So then we will do interest rate risk management as well, then a question of appraisal as well. And the reason why I've made the WhatsApp group for all of you, I would advise all of you, obviously, there are some different types of webinars from different platforms as well. I would advise you to share this WhatsApp group link among your friends and people who know, because on those WhatsApp group, I won't be just sending these 4 to 5 videos. I will be sending 5 to 10 extra videos for you. Okay. Complimentary, no charges, okay? Extra videos, just to ensure that before going to exam, you will be doing 14, 15 past paper questions through my technique. You will see just after this webinar session, that's how these techniques work. Okay, so this was my introduction, and using my techniques, the pass rates have been fantastic. The nationwide, worldwide position winners have been fantastic. I teach many exams, and this is one of my favorite exams because I really like the financial management and advanced financial management paper. Okay, so let's start now with currency risk management. Okay. Okay, we will share WhatsApp group link after every regular interval, so don't worry. Okay. Now, if we talk about currency risk management, the first thing a student should know is that what exactly is currency risk. If we talk about currency risk management, a student should know what exactly is currency risk. Okay. What exactly is the currency risk? Currency risk is basically a risk that currency rates go up when you are making a payment, okay, or risk that currency rates go down when you are receiving, okay. Currency risk is basically the risk that currency rates go up when you are making payment and currency rates go down when you are receiving, okay. Didn't get it? What is the meaning of this? Okay, now let me discuss with you an example. Let's suppose we all are ACCA guys and we want to give exam. We all are ACCA guys and we want to give exam. And obviously all of us are not from UK. Okay, I'm not talking about those people who are in UK. Obviously we are from different countries. Okay, now let's suppose I'm in Pakistan. I'm an ACCA student, for example, and I have to pay ACCA fees of 100 GBP, 100 pounds in, let's suppose, April. I plan to register for June attempt, and I want to pay ACCA fees of 100 pounds in April. Okay, there is always a risk in my mind. What is that risk? That maybe when April comes, the currency rates go up and I suffer loss. This is currency risk. Okay, or someone is going to send me $100 after 2 months. There is always going to be a risk that currency rates may go down. This is currency risk. That risk that currency rates go up when you pay and currency rates go down when you plan to receive. Okay. Similarly, let's suppose there is a student who is sitting in, let's suppose, Nigeria at the moment. Okay. And he plans to register for ACCA June exams, or he wants to pay annual subscription fees of ACCA next year. He will always be facing a risk that till that the pound rate goes up. This is currency risk. Or he's receiving a remittance of, let's suppose, $500. There's always a risk that rates go down. This is currency risk. Okay. Now, this currency risk can never be eliminated. It can only be minimized or managed. This currency risk can never be eliminated. Okay. It can only be minimized or managed. Now, we basically minimize or manage currency risk through the use of some hedging techniques. Okay, this currency risk can never be minimized or managed, eliminated, sorry. It can only be minimized or managed. And this currency risk is managed or minimized through some hedging techniques. The most commonly used hedging techniques to manage currency risk are forward exchange contracts, currency futures, and currency options. Obviously, there are more techniques, but this webinar is inclined to focus on only the most important ones. So the most important techniques to deal with currency risk are currency futures, currency options and forward exchange contracts. Okay, usually when a question comes, it asks for these three techniques: forward exchange contracts, also called forwards, futures, and options. So we will see how do we manage currency risk through these techniques: forward exchange contract, futures, and options. So at the moment, I've told you two things. Number one, we are dealing with currency risk management. What is currency risk? Currency risk is the risk that currency rates go up when you pay, or currency rates go down when you receive. If you have to pay ACCA fees in the future, there is a risk that rates go up, pound goes up. This is currency risk. Okay, how to deal, manage, minimize this risk? There are three most commonly used techniques called forward exchange contract, futures, options. Any questions up till now? You can ask in chat box. Then I will move forward. Okay. Thank you, Aji Ismail, for sharing the WhatsApp group link. Okay. I don't need to mention it's clear and everything. If you have any questions, just ask, because it takes time. It's, in fact, it wastes your time to see at each and every question. Okay. So currency risk is the risk that currency rates go up when you pay. Currency risk is the risk that rates go down when you receive. And this can be managed or minimized through the use of commonly used hedging techniques like futures, options, forward exchange contracts. Okay. Now, Daniel, I will tell you everything. Don't worry. Now, the first technique to deal with currency risk is basically forward exchange contract. The first technique to deal with currency risk is basically forward exchange contract. Now, what exactly is forward exchange contract? What exactly is forward exchange contract? Okay. In forward exchange contract, what we do is we basically fix a rate for a future transaction. What do we do in forward exchange contract? We basically fix a rate for a future transaction. Okay. Like, for example, we plan to pay ACCA fees of £100 in June. We are afraid that rates may go up. We fix a rate. This is forward exchange contract. Similarly, let's suppose I'm in Pakistan and I will receive $1,000 in May. There is always a risk rates go down. We fix a rate. Okay, this is forward exchange contract. Okay. Now, in solving forward exchange contract, we need to have the understanding of currency principle called quotes. While understanding forward exchange contract, we need to have the understanding of currency figures, which is called quotes. Okay. Now, there are two types of quotes: indirect quote, direct quote. There are two types of quotes: indirect quote and direct quote. Okay. Indirect quote is basically three principles of all you need to learn: foreign currency over local currency. If that is the quote, you divide to convert. And an indirect quote, the lower rate is the buying rate, higher rate is the selling rate. Okay. And direct quote is basically local currency over foreign currency. Once you find direct quote, you multiply to convert. Okay. And here, the lower rate is the selling one, and the higher rate is the buying. Okay. Now, without understanding or having the knowledge of quotes, it's highly unlikely that you will be able to do any question of currency risk management. Okay, so these are some conversion principles which you must learn as soon as possible if you have to solve a currency risk management question. Okay, what is that thing? That in indirect quote, basically it's foreign currency over local currency. Whenever you see foreign currency in numerator, local currency in denominator, that's an indirect quote. You divide to convert, and the lower rate is the buying one and the higher rate is the selling. Okay, similarly, if you find anything like this, that local currencies in numerator and foreign currencies in denominator, that's a direct quote. In that case, you multiply to convert, and lower rate is the selling rate and the higher rate is the buying rate. Now, what exactly I'm trying to say here is that let's suppose we are in UK and we see somewhere pound over dollars. We see somewhere pound over dollars. So what is the local currency of UK? It's pounds. It's in numerator. If local currency is in numerator, you will say it's a direct quote. Second step, you will multiply to convert. And third step, lower is the selling, higher is the buying. However, if I'm in USA and I find somewhere dollar over, let's suppose, Pakistani rupees, what is the local currency of USA? It's dollar. Dollar is coming in numerator. It's again a direct quote. Okay, you multiply to convert, lower it is the selling, higher it is the buying. But let's suppose I am in USA and I see somewhere euro over dollars. Now, what is the local currency of USA? The local currency of USA is dollars. It's coming in denominator. If local currency is in denominator, that's an indirect quote. You need to divide to convert, and lower is the selling, higher is the buy. Okay. I think you should copy this, and then I will give you two examples or three examples so that you can easily grasp it. Okay. In the meantime, if you have any questions from codes, please ask me. Throw, you have to think from our side that we are buying or we are selling. Okay. Yeah. I'm explaining it to you through two to three examples. Okay, so I want you all to stop copying for a moment and just focus on what I am telling you here. Okay, look how we solve the forward exchange contract. Look how we solve the forward exchange contract. Now, forward exchange contract is basically rate fixation. And I told you that to learn how to solve forward exchange contract, we need to understand the principle of quotes. Okay, now there are two types of quotes. One is indirect quote and one is direct quote. Okay. Now, if we talk about the quotes, if foreign currencies in numerator, local currencies in denominator, we say it's an indirect quote, we divide to convert, and the lower rate is the buying rate, higher rate is the selling rate. Okay. And when it's a local currency numerator, foreign denominator, it's a direct quote. If local currency is the numerator, we multiply to convert, lower is the selling, higher is the buying. Now, solving forward exchange contract is just a three-step solution. Okay, like look at example number one. We're in Pakistan and we must pay $1,000 after 3 months. Okay, rates are dollar over PKR. 1 month forward rate is given, the rate you are getting for 1 month. 2 month forward rate is given, the rate you are getting for 2 months, and 3 month forward rate is given. Okay, it says how much PKR will be involved in the forward exchange contract. So basically, if you are in Pakistan, look at the example, and you must pay $1,000 after 3 months. Is there any risk? Yes, you have to pay $1,000 after 3 months. There is a risk that rates may go up. You need to hedge. So it's saying how much will be involved in the forward exchange contract. It's just a three-step solution. Okay, step number one. You are in Pakistan and you must pay $1,000 after 3 months. So which row is relevant? Only this 3 months. Step one, you are in Pakistan. You must pay $1,000 after 3 months. So the only relevant row is 3 months. Why are you going to look at 1 month or 2 months? You're in Pakistan, you need to pay 1,000 after 3 months. Only 3 month row is relevant. Step two, quote. You're in Pakistan. Local currency is Pak rupees. It's denominator. That's an indirect quote. You will divide to convert. And this lower rate is the buying rate, higher rate is the selling rate. Step two is done. What was the step one? You're paying after 3 months, only 3 month row is relevant. Second, quote. You're in Pakistan, Pak rupees is in denominator, indirect quote, divide, slower buying, higher selling. Okay. Last step, do the transaction. How much you have to pay? 1,000. The question's requirement asks how much PKR will be involved. You have to pay 1,000. The question requirement asks how much PKR will be involved. So you convert it into PKR. How will you convert? Multiply, divide, divide. You are paying, right? So when you are paying, you need to buy. When you are paying, you need to buy. You are paying fees to ACCA. What are you doing? You're buying pounds. So whenever you are paying, you need to buy. So divided by the buying rate, it's 0.09. Answer comes 1,000 divided by 0.09, 11111. So this is the three-step solution. Highlight the relevant row, note the quote, okay, and thirdly, do the transaction. You are paying. So obviously, when you are paying, you need to buy, divided by the buying rate. That's the answer. Sorry, it's 009. I made a mistake. 0.009. 11111. Okay, let's get some more practice in example number two. Please pay attention, then you can copy. Please pay attention, then you can copy. We are in US and we will receive euro 5,000 after 4 months. So again, if you're in US and you're receiving euro 5,000, there is always a risk. What is the risk? Rates may go down. You're in USA and you will receive euro 5,000 after 4 months. There's always a risk that rates may go down. The rates are euro per dollar. Like you were in USA. You are receiving euro 5,000. There's always a risk that rates may go down. Okay. Rates are euro per dollar, 2 month forward rate, 4 month forward rate, 6 month forward rate is given, and how much dollars will be involved in the forward exchange contract. It's asking how much dollars will be involved in the forward exchange contract. Again, 3 steps for forward exchange contract. Number one, you are in USA and you will receive euro 5,000 after 4 months. So the only relevant row is this, 4 months. You are in USA, you will receive euro 5,000 after 4 months. Only relevant row is 4 months. Second, get the quote. You are in USA. Local currency is dollar. It's in denominator. Again, it's an indirect quote. You will divide to convert, and the lower rate is the buying rate, higher rate is the selling rate. Last step, do the transaction. How much euros you are receiving? Euro 5,000. How much euros you are receiving? Euro 5,000. Okay. It's asking how much dollars will be involved. How much dollars will be involved? Convert it into dollars. Multiply, divide, indirect code divide. You're receiving. Whenever we are receiving something, we sell. If you will receive $5,000 from somewhere, what will you do? You will sell. Selling rate 0.84. It's $5,952. Okay, so this is how forward exchange contract work. Highlight the relevant row. Second, understand the code. And the third, do the transaction, multiply or divide. If it's receipt, we sell. If it's payment, we buy. Any questions you may please ask. Just try this one more example, then we will move forward. Actually, there are some students who ask questions. So when I reply to them, I usually pause it. So no need to worry if my lips are moving and you're unable to hear anything, okay? At the examination time, there are students getting confused unnecessarily because of pressures. So don't worry about it. I haven't said anything. I've just written the format and I've not solved, so don't worry. That voice is not coming. Again, this is examination stress, which is making you worried. Yeah, 3 to 4 people have started calling me on WhatsApp that we are unable to hear you. Okay, there is one basic concern, as I can see from the questions, that obviously this is being conducted for students from around the world, not just a specific country. So, in some countries of the world, there is the exam is being conducted paper based, and in some countries it's computer based, so people want me to have an idea of computer based as well. Now obviously I'm solving it on the paper, so the people who are giving paper based exams, they will be really happy, but those who are only giving this computer based, they will not be happy. So that's what the purpose of that WhatsApp group is. I will be going to share 2 more questions of this currency risk management, 2 past paper questions, which I've solved on spreadsheet Excel. I would request all of you to view those 2 videos as well. There are 2 advantages, no matter if you are giving paper-based or computer-based, okay? 2 new questions means further strengthen the practice. And secondly, those who are giving on computer-based, they will also get an idea, okay? Now let's complete this question. We are in UK, we'll pay 2,000 after 3 months. So I told you the only relevant row is 3 months. Second, get the quote. You are in UK. Pound is a numerator. It's a direct quote. You will multiply, and the lower it is the selling rate, higher is the buying rate. Okay. Finally, do the transaction. You need to pay $2,000. Okay. How much pounds will be involved? Convert into pounds. Multiply, divide, multiply, direct quote. You are paying, you will buy 0.781560 pounds. Okay. Hope you get it. Now move towards the next technique. It's currency futures. Ibrahim, I told about the 2 videos that I will send it on the WhatsApp group as a complimentary 2 videos. 2 new questions will be practiced and on Excel. Now, like I gave you, Now, when we talk about currency futures, like I told you 3 steps about forward exchange contract, currency futures is also 3 steps, okay? The first step is find lock-in rate, then expected receipts payments using this lock-in rate, and then number of contracts, okay? What is this lock-in rate? Now, lock-in rate is the average rate. Lock-in rate is the average rate. Like for example, you need to pay someone after 3 months. You need to pay someone after 3 months. So you need to pay someone after 3 months. You need a rate for 3 months, right? You need to pay someone after 5 months. So definitely you need a rate for 5 months. You will be receiving money after 6 months. So you need a 6-month rate. Now, in some cases, this 3 months, 6 month, 5 month rate is given, but sometimes what happens is you need to pay after 3 months. You need a 3-month rate, okay? But the question provides you 2-month rate, it's 1.5, and 4-month rate, it's 2. You need to pay after 3 months, you need a 3-month rate. The question is giving you 2-month rate, 1.5, 4-month rate, 2. In that case, you need to find the lock-in rate for 3 months. How do you do that? You just use the trend analysis. 2-month rate is 1.5 and 4-month rate is 2. That means trend is rising for 0.5 in 2 months. If trend is rising by 0.5 in 2 months, that means it's rising by 0.25 per month, right? If trend is rising by 0.5 in 2 months, that means it's 0.25 per month rising. Now, how do you get a 3-month rate? It's simple. 2-month rate is 1.5. You need to get a 3-month rate, 1 month later rate, and the rate is increasing by 0.25 per month. So the 3-month rate is going to be 1.75. This is called lock-in rate or average rate. Okay, repeat. If you need to pay after 3 months, you need a 3-month rate. If the question gives you 3-month rate, don't worry. But if the question gives you a rate of 2 months and 4 months, average it out. Rising trend of 0.5 in 2 months, so per month it's 0.25. Get a 1.5 2-month rate and increase it by 0.25 per month, you get 1.75 3-month rate. Similarly, you need to pay someone after 5 months. So you need a 5-month rate. If 5-month rate is given, it's fine. Okay, but if 5-month rate is not given, instead it states 3-month rate is 2 and 6-month rate is 2.3. You need a 5-month rate. Again, use the trend analysis. 3-month rate 2, 6-month rate 2.3. It's rising by 0.3 in 3 months. Rising by 0.3 in 3 months. If it's rising by 0.3 in 3 months, you can divide it. It's rising by 0.1 per month. Okay. Now, if the rate is rising by 0.1 per month, okay, you take the 3-month rate, 2, that's a 3-month rate, and it's rising by 0.1 per month. This is the 3-month rate. If you add 0.1, it's rising per month, you get to 4 month. And if you add 0.1, you get to 5 month. 5-month rate is 2.2. This is called the lock-in rate or average rate. Okay. Lastly, you will be receiving some money after 6 months. So you need a 6-month rate, right? You will be receiving something after 6 months. You need a 6-month rate. Okay. Now, if the question gives you 6-month rate, it's fine. But let's suppose you are provided with 5-month rate 0.9 and 7-month rate 0.5. You can get a 6-month rate. How? 5-month rate 0.9, 7-month rate 0.5. It's showing a falling trend of 0.4 in 2 months. If it's falling by 0.4 in 2 months, that means per month it's 0.2 falling. You can then do it. Let's suppose 5 month rate is 0.9. It's falling by 0.2. So next month it will fall by 0.2. So the 5 month rate is going to be, 6 month rate is going to be 0.7. This is called lock-in rate. Once you get the lock-in rate, you move to step two, receipts payment using this lock-in rate. And thirdly, you get the number of contracts. Okay, this is how futures work. Now I'll move towards options. I will show you the format of options and then we will move towards the past paper question. Okay, to help you understand how it applies. Okay, any questions with the lock-in rate you can ask. No, Abdul Ghaffar. The approach you are referring to, that's the difficult approach of KIT and past papers. See my approach, very easy, and you will reach the same answer. People are asking about the session. It would take 1 more hour because we need to do a past paper question as well. Yes, definitely. HP laptop point. I think I have edited that, the question which you're asking, that it's a spot rate. Okay, I have corrected it. Okay. Now I'm just explaining it quickly, and then we were moving towards the past paper question. Okay. Now, as far as the options are concerned, okay, you must have the knowledge that options are different in receipts and different in payments. Like when we are paying, we are obviously buying. That's call option. And when we are selling receipts, it's selling and it's put option. Okay, there are two types of options, one in payment, one in receipt. In payment, we are paying someone, we need to buy. I told you above in forward as well. So you use call option, and in receipt you use put option. Okay. Now my formula for currency options is for receipts is expected payments, expected receipts in local currency using excise price plus unhedged receipts minus premium payable. And for payments, my formula is similar: expected payments in local currency using excise price plus unhedged plus premium payable. Now, why in one thing premium is added and one in one thing premium is subtracted? Now, when you enter into options, you need to pay premium, right? When you enter into options, you need to pay premium. Premium increases my cost, so I add it in payments. But when I enter into options, I need to pay premium. Premium reduces my receipts, therefore I'm deducting in receipts. Getting it? When you are making payment, you need to pay premium. Obviously, premium has to be paid, it increases my payments. But premium has to be paid, it reduces my receipts, so I deduct it. Okay. And the formula is common for expected receipts or payments. It's number of contracts into contract size. How to get number of contracts? It has a sub formula. Now, let's suppose the formula of number of contracts gives you that you take 99.3 contracts. So no one is going to give you 99.3 contracts, right? You will eventually end up taking 99 contracts. Okay. Or let's suppose your number of contract answer gives you 100.2 contracts. So no one is going to give you 100.2 contracts. You have to settle for 100 contracts. Since you didn't take full contracts, there is some unhedged amount left, which is calculated through this formula. Okay, obviously, when you are not able to take full contracts, the question is saying take 108.4 contracts, but you're only able to take 108 contracts because no one offers contracts in decimals. There will be some unhedged amount left. How do you calculate this unhedged? It's in front of you. But remember, there is no technique which deals with unhedged amounts. There is no technique which deals with unhedged amounts. So I've written unhedged is dealt through forward exchange contract. Unhedged is dealt through forward exchange contract, right? There is some unhedged amount left. So unhedged is dealt through forward exchange contract. Okay. Please pay attention. Don't ask questions. I will just give you time to ask questions. And then in options, you have to pay a premium. The formula of premium is in front of you. And remember, when entering into options, premium has to be paid immediately. So we use spot rates. Okay. Now the question is, if we give 99.100 contracts, sorry, 99.8 contracts, what to do? Okay. Now, if you're following my strategy is always to round down. And if you have plans to look for more questions from my side, which I will be sharing in your groups, my strategy is always to round down. Even if it's 99.8 contracts, I round down 99. Now, why is that? Because my format works this way. Like, let's suppose you have 99.8 contracts and you take 100 contracts. That means you are taking more contracts. This will make it overhedged. That's allowed in the exam, right? That's not a wrong strategy. It makes it overhedged. And in overhedged, rather than adding, you deduct here. Rather than adding here, you deduct here. Okay. So if you are following my strategy, I would advise you not to learn multiple things that okay, in some cases it will be added, in some it will be, no need to run this. Okay, just do one thing, that when you get unhedged or number of contracts in decimals, always do round down, okay, to make it comfortable with my format. Okay, now I will explain these questions to you via a past paper question. So I would advise all of you that we will be doing the question from last attempt through my formats, and I hope that you will like it, so you will apply this format in the future. Okay, so the question I'm sharing or opening, I want all of you to open that question on your screens as well. Sorry, the last attempt question was interest risk management. And this one obligation just creates a chance for currency risk to be tested here in this attempt. Okay, so this is the question. The name of the question is BOULLAIN company. It's in front of your screens, but I want you all to open it on your screens as well, because then I will do the solution. Okay, I'm just giving you 2-3 minutes to open this question. Yeah, March 2020 attempt W. And just 2-3 minutes to go through this question. I will read it obviously, but after 2-3 minutes. Okay, first you read. Okay, I'm pausing my video at the moment. Just 2-3 minutes, I will then resume. Okay. Okay, so let's start this question. The question states, BOULLAIN company is based in the Eurozone and manufactures components for agricultural machinery. So the important point is that BOULLAIN is based in Eurozone. It manufactures components for agricultural industry. The company is financed by a combination of debt and equity, having obtained a listing 5 years ago. In addition to the founders' equity stake, the shareholders consist of pension funds and other institutional investors. Until recently, sales have been generated exclusively within the Eurozone area, but the directors are keen to expand and have identified North America as a key export market. Company recently completed its first sale to a customer based in United States, although payment will not be received for another 6 months. Okay. Now, the important point in this paragraph was that the company is based in Eurozone. The company is based in Eurozone. Okay. Dhruv, please wait a minute. Okay. Let me complete the question, then we will solve your queries. Okay. So the company is based in Eurozone. Okay. Hedging policy and key stakeholders. At a recent board meeting, Poland's finance director argued that expansion into foreign markets creates the need for formal hedging policy and that shareholder value would be enhanced if this policy was communicated to the company's other stakeholders. However, Bullen's CEO said disagreed with the finance director on the following grounds. First, existing shareholders are already well diversified and would therefore not benefit from additional risk reduction hedging strategies. Second, there is no obvious benefit to shareholder value by communicating the hedging policy to other stakeholders such as debt providers, employees, customers, suppliers. You have been asked to provide a rationale for the finance director's comments in advance of the next board meeting. CEO's finance director, the company's finance director, he's saying that we need to communicate a formal hedging policy, but the second director is saying there is no need for such hedging products. Now, assume today's date is 1st March 2020. This is an important point. Okay. So today's date is 1st March 2020, right? Bullen is due to receive 18.6 million from the American customer on 31st August 2020. And look at my fingers. Today's date is 1st March 2020. And I will be receiving 18.6 million from American customer on 31st August 2010. Just count it. Today is 1st March. And I will receive payment on 31st August. After how many months? Today is 1st March. 1st April, 1 month. 1st May, 2 months. 1st June, 3 months. 1st July, 4 months. 1st August, 5 months. And 31st August, 6 months. So I will receive this payment after 6 months. Again, today is 1st March. I will receive on 31st August. So 1st March to 1st April, 1 month. 1st May, 2 months. 1st June, 3 months. 1st July, 4 months. 1st August, 5 months. And 31st August, 6 months. Okay, today is 1st March 2020, and we will receive 18.6 million after 6 months. Okay. So today's date is 1st March, and Bullion is due to receive 18.6 million from American customer on 31st August 2020, 6 months to 2010. The finance director is keen to minimize company's exposure to foreign exchange risk and has identified forward contracts, futures, and options as way of achieving this objective. So he has identified forwards, futures, and options as objective. The following quotations have been obtained. Exchange rates are quoted as euro per dollar. Standards are euro per dollar. Spot 2 rates are given and 6-month forward rates are given. So you are given spot rates as well as 6-month forward rates. Futures data is given contract size euro 200,000, exercise price is dollar per euro. Now carefully look in the first portion, the exchange rates were euro per dollar. Now in this futures, it's dollar per euro. March, June, September data is given. Pay attention. In futures, March, June, September data is given. Okay. Now, if you look at the March, June, and September data, it's 1.1476 the exercise price, 1.1449, and 1.1422. Okay. So you are given futures data for March, June, September. Now, always remember to convert it into months, the number months, numeric ones, not this alphabetical ones. Now, this March, June, September always means 30th March, 30th June, 30th September, because the futures and options settle at month end always. So it's 30th March, 30th June, 30th September. Now, you can do it like this, that today's date is 1st March, right? And you are given futures of 30th March, 30th June, 30th September. Okay, you can replace it in numeric form like this. Like for example, today's 1st March, look at my fingers. You're given future of 30th March. That means it's for exactly 1 month. Today's 1st March, you're given future of 30th June. So 1st March to 1st April, 1 month. 1st May, 2 months. 1st June, 3 months. And 30th June, 4 months. And today's 1st March, you are given future of 30th September. So 1st March is today. 1st April, 1 month. 1st May, 2 months. 1st June, 3 months. 1st July, 4 months. 1st August, 5 months. 1st September, 6 months. And 30th September, 7 months. Always remember to replace this alphabetical months with the numbers. Always remember to replace this alphabetical months with these numbers. Okay, that's what I did with 30th August. That you were supposed to receive 18.6 million after 6 months, 31st August. So I told that when you are receiving 18.6 million on 18.6 million on 31st August, today's 1st March, 1st April, 1st May, 1st June, 1st July, 1st August, and 31st August. That means you're receiving after 6 months. Futures is given of March, June, September. That always means 30th March, 30th June, 30th September. So 1st March is today. The future of 30th March is given exactly after 1 month. Today's 1st March, future of 30th June is given. 1st April, 1st May, 1st April, 1st May, 1st June, 30th June, 4 months. And today's 1st March, 1st April, 1st May, 1st June, 1st July, 1st August, 1st September, and 30th September. 7 months is given. Okay. Then you are given, look at the question again. You are given data of currency options. The contract size is 200,000 euros. Exercise price is again dollar per euro. You must see that where euro per dollar is given and where dollar per euro is given. You are given exercise price as 1.142. You are given call options for March, June, September, and you're given put option for March, June, September. Okay. Assume futures and options contract mature at the month end. There is no basis risk. The number of contracts to be used should be rounded down to the nearest whole number in calculations. It's written that the number of contracts should be rounded down. It states number of contracts should be rounded down to the nearest whole number. If the full amount cannot be hedged using an exact number of futures or options, the balance is hedged using forward market. I told you if the full amount is not hedged, the balance is hedged using forward. Then some margin information is given. I want you to ignore that because we are doing hedging at the moment. Come to part B, please. Recommend a hedging strategy for Bullen's foreign exchange receipt in 6 months' time based on hedging choices the finance editor is considering. Support your recommendation with appropriate discussion and calculations. I've opened the question on a separate screen. Now I won't be going back to the screens. Therefore, I advise you to download this March 2020 past paper on your tablets or laptops or whatever, so you can see the question from there and where I'm taking values from. Okay. Recommend a hedging strategy for Bullen's foreign currency receipt in 6 months' time based on hedging choices, financial risk constraints, support recommendations with appropriate discussion. Now, I want you all to open the question again, and I'm just giving you a quick recap of the question. I want you all to go back to the question again, and I'm giving you a quick recap of the question. Please come to the first paragraph of this question again. Bullen is based in Eurozone. So the company is based in Eurozone and manufactures components for agricultural machinery. Companies financed by combination of debt and equity, etc., etc. Come to second paragraph, because now it's a summary. At a recent board meeting, Bullen's finance director argued that expansion into foreign markets creates need for formal hedging strategy, but the CEO disagreed. Okay, third paragraph. Assume today is 1st March 2010. Pay attention. Today is 1st March 2010. Okay. Bullen is to receive $18.6 million from American customer. It is based in Euro. It is receiving 18.6 million from American customer on 31st August. So today's 1st March. It is going to receive 18.6 million on 31st August. So look at my finger. Today's 1st March. I will receive it on 31st August. 1st April, 1 month. 1st March to 1st April, 1 month. 1st May, 2 months. 1st June, 3 months. 1st July, 4 months. 1st August, 5 months. And 31st August, 6 months. They're receiving 18.61 million after 6 months. Okay. Correct? The finance director is keen to minimize the company's exposure to foreign risk and has identified forwards, futures, and options as a way of achieving this objective. He's considering forwards, futures, and options. Following quotations have been achieved. Exchange rates are quoted at euro per dollar. Spot and 6-month forward is given. Futures contract size is euro 200,000. Its exercise price is US dollar per euro. Now it's dollar per euro. March, June, September futures are given. Now, if futures are given for March, June, September, it's always 30th March, 30th June, 30th September because futures settle at the month end. Now, if today's date is 1st March and 30th March future is given, it's exactly 1 month. If today's date is 1st March and 30th June future is given, 1st March to 1st April, 1 month, 1st May, 2 months, 1st June, 3 months, and 30th June, 4 months. And today's date is 1st March, you're given futures of 30th September. So 1st March to 1st April, 1 month, 1st May, 2 months, 1st June, 3 months, 1st July, 4 months, 1st August, 5 months, 1st September, 6 months, and 30th September, 7 months. So 1 month, 4 months, 7 months. Always convert this alphabetical months into numeric months. Then options, it is given contract size 200,000 euros, exercise price dollar per euro, premium is cents per euro, and exercise price is 1.1420. Calls for March, June, September are given, puts for March, June, September are given. Okay. Now, part B, recommend hedging strategy for Bullen's foreign exchange receipt in 6 months' time. You need to recommend a hedging strategy for foreign currency receipt. Now, what is this foreign currency receipt? 18.6 million in 6 months. What is the foreign currency receipt? 18.6 million in 6 months. So you need to recommend a hedging strategy for foreign currency receipt. Now, how will you recommend a hedging strategy? The company is considering 3 strategies, right? Forward exchange contract, okay, futures, and options, right? Company is considering forward exchange contract, futures, and options. Now, how will you recommend which is the best strategy? Recommend a hedging strategy. Obviously, you have to solve all 3 and then decide. There is no way you can decide without solving all 3. So you need to recommend a hedging strategy. And to recommend a hedging strategy, you need to first solve all 3 hedging strategies and then decide. I will solve forwards, futures, options, and then decide which is the best one. I will solve forwards and futures first. I will want you to pay attention. I will then give you copying time. Don't copy in between, and then we will go towards options. Okay. So let's start. Recommend hedging strategy. The first hedging strategy is forward exchange contract. Now, we are receiving 18.6 million after 6 months. We're receiving 18.6 million after 6 months. Let's solve it through forward exchange contract. Okay. You know that for forward exchange contract, you will only look at forwards data. For forward exchange contract, you will only look at forwards data. Okay. Why there is a need to look at options and futures? Only look at forwards data for forward exchange contract. Okay. So 3-step approach. Number 1, highlight the relevant row. Go to forward exchange contract, highlight the relevant row. If you're receiving 18.61 million after 6 months, only 6-month row is relevant, right? If you're receiving 18.6 million after 6 months, only 6-month row is relevant. Highlight the 6-month row. Second quote. In forward, it's euro per dollar. So we are in Europe. It's euro per dollar. Euro is a numerator. It's a direct quote. You should multiply. And the lower rate is the selling rate, higher rate is the buying rate. Okay. 0.8729 is the selling rate, 0.8744 is the buying rate. Finally, solve the transaction. How much you are receiving? $18.6 million. Will you multiply or divide? In the last step? Multiply. You are receiving, you need to sell. You are receiving, you need to sell. Sell. What is the selling rate? Lower. 0.87. $29. It's 16.23 million euros. This is what forward exchange contract is. Don't copy it. I will give you time after futures. Now I solve it through the three-step formula. I'm receiving 18.6 million after 6 months. The only relevant row was 6 months. I'm only looking at forwards data. Then the quote, it's euro per dollar. I'm in Eurozone. It's a direct quote, multiply. Then 18.6 million is the receipt, multiply, divide, multiply. I'm receiving, I need to sell. 0.8729, 16.23 million. Okay. Now I'm solving futures. I want you to pay attention and then copy. Okay. Now futures. Futures has 3 steps. Futures has 3 steps. Step 1. Lock-in rate. Pay attention, please. Step 1 is the lock-in rate. Okay. Now, I'm receiving money after 6 months, right? I'm receiving money after 6 months. Okay. So I need the rate for 6 months. I'm receiving money after 6 months. So I need the rate of 6 months. If you go in futures and 6-month rate is given, just capture it. But when you look at futures, the 6-month rate is not given. 4 months, 7 month, 1 month is given. This is not usable. I am receiving 18.6 million after 6 months. So I need a 6-month rate. When I look at futures, strange, the 6-month rate is not given. I am provided 4-month rate 1.1449 and I am provided 7-month rate 1.1422. I need to find a 6-month lock-in rate. I need to find a 6-month lock-in rate. How will I do that? Look at the trend from 1.1449. It's falling to 1.1422. 1.1449, 1.1422. It's falling by 0.0027 in 3 months. Okay. If it's falling by 0.0027 in 3 months divided by 3, it will give you how much it is falling per month. Falling by 0.0009. Per month. Okay, now you can get a 6-month rate. The 4-month rate is 1.1449. It's falling by 0.0009 per month. So if you fall it by 0.0009, it will reach 1 month later, 5 months, and then further 0.0009. It will reach 1 month more, 6 month. So the 6-month lock-in rate is 1.1431. This is the first step. Find the lock-in rate. Had the 6-month rate been given, I would have used that. But if it were not given, I used the lock-in rate. Okay. Second step, expected receipts or payments using this lock-in rate. So expected receipts using lock-in rate. What is the receipt? 18.6 million. You need to get the receipt using this lock-in rate. Will you multiply or divide? If you go to futures data in the question, for futures, you need to look at futures data. In futures, the rates are dollar per euro. In futures, the euro is in denominator, it's an indirect code. So you need to divide by this lock-in rate, 1.1431. It's euro 16.27 million. Okay, so the first step was lock-in rate, expected receipts or payments using this lock-in rate. Okay, and finally, the last step is number of contracts, the amount you are receiving. The amount you are receiving is 16.27 million, and you can go in the question and see the contract size is 200,000 euro. That means in millions, it's 0.2 million. In millions, the contract size is 0.2 million. You get the number of contracts as 81, approximately. Copy it, please, then I will discuss it. Okay, please copy. Now, as far as this number of contracts is concerned, you are receiving receipt of 16.27 million euros, right? In step 2. Now my receipt is 16.27 million euros. And if you go in futures data, the contract size is 200,000. That is 0.2 million euros because I'm working in euros. 16.27 million I have to receive, and I'm getting it in pieces of contract sizes of 0.2 million. So the number of contracts would be 81. I have to take 81 contracts, okay? Copy, then I will start options. Let me check the chats. Okay, Dhruv, as far as your question is concerned, you used that basis risk approach, which the examiner uses, and you still got 16.27 million. And this easy strategy also produces 16.27 million. So now it's your choice which strategy you want to use. Okay. And the second question is from a student. I can't see his name. Let me just check. Antojos. Had the contract size been in dollars, my life would have been really easy. I'm receiving $18.6 million and the contract size is also in dollars. Just divide and get it. No need to worry about it. Okay. No, Dhruv, you are seeing wrong. My answer is also 16.27 million. It's not 16.23 million. Okay. Let me now move towards options, and after options, our question and class would be over. Okay. Now, in options, the formula is it a receipt case or a payment case? It's a receipt case, okay? So the formula for receipts is expected receipts in foreign currency using exercise price plus unhedged amount minus the premium payable. Okay, expected receipts in foreign currency using exercise price plus unhedged minus premium payable, the formula which I told you. Okay, now we will find all these three things. The expected receipts thing, the unhedged amount thing, and this premium thing. We will do all these three and then adjust it in the formula to get the desired answer. Okay, now let's start. Now I would advise you one thing. When starting option, always select whether you would go for call option or put option. That's the first thing you need to learn in options. That whenever you want to go for options, always learn whether I want to go for call option or I want to go for put option. Now, how will you decide? I want you to open the question and focus on the options data. Okay. Now, as a general rule, when you are paying, you need to buy, take call option. When receiving, you need to sell, take put option. As a general rule, that when you are paying, you're paying, you need to buy call. When you are receiving, you need to sell put. General rule, but this depends on contract size. Now, see, you are receiving 18 point. You're in Europe, right? You are receiving $18.6 million. You're in Europe. You're receiving $18.6 million. So what you will do? You will sell $18.6 million. You are selling dollars. That means you need a put option for dollars. But when you go to the option provider, he is offering contract size in euros. Now you are receiving dollars. You need to sell dollars. You are receiving dollars. You need to sell dollars. Sell dollars means take put option for dollars, but he's not giving option in dollars. He's giving option in euros. So you need to think one thing. Selling dollars in Europe means getting what in return? Euros. Selling dollars to a money changer in Europe means taking euros. If the contract size is in dollars, you are selling dollars, take put option. But if the contract size is in euros, you are selling dollars, but taking what? Euros. Taking means buying euros, take call option. Sir, in receipt, you are saying us to take call option. Yes, exactly. It's not something you should rote learn. Okay, it's not something that you should rote learn. That in payments we buy, always take call. In receipts we sell, always to take put. It is a rule. I'm not saying that. But Let's suppose you are in Europe and you need to pay dollars, or I'm in Pakistan, I need to pay someone dollars, $1,000. If I have to pay someone $1,000, I will go to money changer option provider and buy dollars. I have to pay someone $1,000, I will buy. Buying dollars means taking call option. But let's suppose my money changer says I'm only giving options in PKR. So I need to pay dollars, I need to buy dollars, take call option for dollars, but he's giving in PKR. So buying dollar means what I'm giving, PKR. Buying dollars means giving PKR, selling PKR. If the contract is in dollars, I'm buying dollars, take call option. But if it's in PKR, I'm selling PKR, take put option. Similarly, I'm in Pakistan, I will receive $1,000. If I'm receiving $1,000, I will go to money changer and sell dollars, take put option, sell dollars. But let's suppose he says I'm giving contract in PKR. So selling dollars means taking, buying PKR. If it is giving in dollars, I'm selling dollars, put option for dollars. But if it is giving in PKR, I'm taking, buying PKR, take call. That's exactly what is happening here. To start options, immediately decide call or put. I am in Europe. I'm receiving $18.6 million, so I will sell dollars. Sell dollars means take put option of dollars. If it's giving option in dollars, I'm selling dollars, put. But if it's giving contract in euros, I'm in Europe, I'm selling, receiving dollars, I will sell dollars, but take euros. Sell dollars means not written empty-handed, take euros. Taking euros means buying euros, take call option. And if it's in dollars, I'm selling dollars, take put option. Here is the offering in euros, I will take call option. The only relevant option for me is call option. Okay, and since payment was being received after 6 months, so March, June, September has been replaced by 1 month, 4 months, 7 months. Since payment was being received after 6 months, I will take the next one, 7 month, September, call option. Okay. Abir, in receipt, we always take put option. In payment, we take call option, but this depends on contract size. If contract size is in dollars, I am selling dollars. I'm receiving dollars. I will sell dollars. I will take put option for dollars. But here the contract size of options is in euros. So selling dollars means taking, buying euros. Since I'm taking, buying euros, and he's offering in euros, I am not selling euros. I am buying euros. Selling dollars, buying euros. I will take call option. Had it been provided the option contracts in dollars, I would have sell dollars, take put option. Okay, now let's start. Expected receipts. The formula of expected receipts, as I've been told to you. Number of contracts into contract size. And number of contracts, the sub formula is expected receipts, that's 18.6 million divided by exercise price. Look at the exercise price in option. 1.1420 divided by contract size, that's euro 0.2 million. Okay, you will get number of contracts. Expected receipts in foreign currency, 18.6 divided by exercise price, divided by contract size, that's 200,000 euros, 0.2 million, because I've solved the whole question in euros. It's 81.43 contracts. No one is going to offer me this, so I will take 81 contracts. So number of contracts is 81 and contract size is euro 0.2 million. This makes it 16.2 million. The first thing, expected receipts. It was very simple through the formula, number of contracts into contract size. Number of contracts was expected receipts over exercise price divided by contract size. 81.43 contracts, round down means 81 contracts, into contract size 0.2 million. This is expected receipts. Pay attention. I will then repeat it. Then we get unhedged. The formula of unhedged is expected payments or receipts in foreign currency. That's 18.6 million minus number of contracts into contract size into exercise price. So number of contracts is 81 into contract size 0.2 million into exercise price 1.1420. So 18.6 million was the receipt less number of contracts. You took 81 into contract size 0.2 into exercise price 1.1420. You were able to hedge 18.5004 million. So the unhedged is 0.0996 million. Okay, so that's quite understandable that since 18.6 million was the receipt, you didn't take full 81.43 contracts, you took less contracts. So some amount remained unhedged. Now, as per the rule, this should be hedged through forward exchange contract. Okay, so this 0.0996 million receipt will be hedged through forward exchange contract. In forward exchange contract, go in forward exchange case. It was a direct quote or an indirect quote? It was a direct quote. Okay, in forward exchange contract, euro was above, it was a direct quote, so we need to multiply. It's a receipt after 6 months, so we'll use 6-month forward rate for selling. Okay, what is the 6-month forward rate for selling? Indirect quote lower is the selling 0.8729. So this makes it euro 0.0869. This is the second thing. Okay, first you got expected receipts as number of contract into contract size, number of contracts through my sub formula, expected receipts over exercise price divided by contract size. 81.43 contracts, I took 81 into contract size 0.2 million, it's 16.2 million euros. Unhedged means expected receipts less number of contracts into contract size into exercise price. 0.0996 million remain unhedged. It was hedged through forward exchange contract. It's a receipt after 6 months. You will use 6-month rate. In forward exchange contract, it was a direct quote. I multiplied. And lower it is the selling one, so 0.8729. The same rate which you took in forward exchange contract, 0.0869 million. So I have got the two things from the formula. Expected receipts, the first thing is 16.2 million. And unhedged is 0.0869. Now I just need the premium, and that would be it. I just need the premium, and that would be it. Now the formula for premium is number of contracts into contract size into premium. Okay, you are taking call option for 7 months, September, because you are receiving in 6 months. So 1 month, 4 months, 7 months, the closest one, or the next one is 7 months. So number of contracts, apply the formula which I provided you above, 81 contracts into contract size, 0.2 million. Into premium. What is the premium? 0.77. This makes it number of contracts into contract size 0.2, and premium you will take call option as we have already decided, the 7-month one, 0.77. Sorry, it was 0.77 cents. So in dollars, it will be 0.0077. It was premium was in cents, so in dollar, it will be 0.0077. So 0.12474 million. Okay, This is the premium. It has to be paid immediately. So use spot rate. Now, how much is the premium? 0.1